So good evening students. Now students, let's start on this particular part on the power of the income tax authority. Students, primarily there are subsections which are to be considered. Good evening all of you students. These are the list of sections, students, wherein the power are being exercised. Now I will just really quickly run through. Good evening all of you. Needy. So I'll just quickly run through the same. 133 students is a power which is available, and by exercising this particular power, any information, students, by exercising this power under 133, now who can exercise the power? Students, the power can be exercised by any income tax authority. And supposedly, students, if the assessing officer is exercising the power under 133, in that case, students, here just you need to check whether there is a pendency of the proceedings or not before the assessing officer. If the proceedings are pending before the assessing officer, then he need not take any approval from the higher authority. But if you say, no sir, there is no proceeding which is pending before the assessing officer, in that particular case, students, the approval from the higher authority, students, will be required. So that is one of the point that you should keep in mind, which is all a procedural point. The second point on 133 is that through this particular power, students, they can give a notice and call for any information which they think which is relevant under the act. They can give the notice and call for any information which they think which is relevant under the act. So the notice can be given, and through that notice any information primarily can be collected, and through that particular information they can proceed further and do their assessment. Now that notice can be given to any person, students, including the banking officer, including, students, a banking officer. So therefore this notice can be given to any person, including to the banking officer, that this notice can be given, and accordingly in this case the information would be called upon. So that is one of the very wide power which is available under 133. So through notice you can call for any information. Now this section 131, which is the next section, which is again a very important power, which is about the fact that they can enforce the attendance of a person through the provision of section 131. It is actually very popularly known as summons. Very popularly, students, section 131 is known as what? As a summons. So by giving the notice under 131, they can enforce the attendance of any person. That is point number one. And not only they can enforce the attendance, point number two, students, they can also call for the books of accounts. Now if they are calling for the books of accounts by giving the notice under 131, then that books of accounts under 131 can be impounded, and that period for which it can be impounded is 15 days. If they want to extend that period beyond 15 days, then for that purpose they need to take the approval from the higher authority. That is the point that you should always keep in mind. Now the person whose attendance has been enforced under 131, that particular person, when they are giving a statement under 131, that statement is considered as an evidence which can be used under any proceeding under this act. That statement is considered as an evidence which can be used under any proceeding under this act. Now in the examination, students, you might find a question which is very popular, that under 131 they will that under 131 the assessing officer or the income tax authority, they are seizing the assets of the assessee. The income tax authority, what they are doing, they are seizing the assets of the assessee. Asset seizure, is it allowed under 131? What I told you, under 131, in this case you can only impound the books of accounts. That is what you are supposed to do. That is what 131, students, is all about. And therefore in that case you cannot seize the assets so far as section 131 is concerned. That seizing the asset is concerned, that is available in one ultimate power, which is the provision of section 132. That is the ultimate power which is under section 132. Now comes to the survey part, students. Now here the survey, students, which has been there. Now just always remember one important point so far as survey is concerned. in terms of the survey, there are two things. One is about taking the approval from the higher authority. Survey would mean first you have to take the approval from the higher authority. Now, which is the authority from whom the permission is required in order to do the survey? So if the information is coming from the prescribed authority, students, in a simple words, if the information is coming from the CIT, okay, prescribed authority means CIT or Director General of Income Tax. So if the information is coming from these authority, then any lower authority like Deputy Director, Assistant Director, Income Tax Officers, Tax Recovery Officer, Assessing Officer, they need to take only the approvals, and the approval will be taken not from the Commissioner but from the Joint Commissioner. So if the information on the basis of which the survey is sought to be conducted, that information is coming from the Commissioner, then in that case the approval by the lower authority will be taken from the Joint Commissioner. Okay, that is point number one. Whereas if the information is from any other source, not from the prescribed authority but from any other source, then in that case the CIT needs to be kept in loop. It means that the approval from the CIT becomes mandatory in this case. So that is the point that you should always keep in mind. So from the prescribed authority, the approval from JCIT, from any other source that the information is received on the basis of which the survey is sought to be conducted, then the authority who wants to conduct the survey, they will have to take the permission from the CIT. Now in this case, students, primarily you should always keep in mind, this is where the point would be there, students. In this case, survey in connection with any functions. So one of the point that you should always keep in mind, generally students always bear this particular point in mind, that where the survey could be conducted, it is the limit, the place within the limit of the area assigned to the income tax authority. So if the jurisdiction is on the basis of the area, if the income tax authority is having the jurisdiction on the basis of the area, then the survey can be conducted in that area. If the jurisdiction is not on the basis of the area but it is on the basis of the person, then any premises which is occupied by that person, on that particular area, the survey can be conducted. Okay, so any premises which is occupied by that person, on that premises the survey can be conducted. What about the event and function, students? There is one special point. Whether if supposingly the event or the function is happening in the area which falls in my jurisdiction, in that case, can I do the survey? Answer is yes, but only one precaution, students, has to be done in this case, is that if you are doing this particular survey in the place of function or the ceremony, then you have to do, students, any time after such function or event is over. Once you decide to do the survey in that functions or that particular event, then the survey can be done at any time after such functions or the event is over. Fine. Now let's see what about the timing when the survey can be conducted. So if it is a place of business, students, in that situation it is during the business hours that the survey can be conducted. If it is a place of business where the survey is sought to be made, then it is during the business hours. Whereas if it is any other place, now be careful here, students, one question which ICI asks in the MCQs, any other place. Now one of the popular question is that the survey is sought to be undertaken in the place, the survey is sought to be undertaken to understand whether the assessee is doing the compliance of the TDS and the TCS provision. So if the survey is sought to be undertaken to understand whether the assessee is doing the compliance of the TDS and TCS provision, then students, please understand, obviously those documents which will be necessary for survey to understand whether the compliance of TDS and TCS provision has been made or not, those documents definitely will not be kept in the place of business. And therefore, if for tedious purpose the survey is supposed to be undertaken, then in that particular case the survey timing would be after sunrise but before sunset. Then in that particular time the survey have to be undertaken after sunrise but before the sunset. Is that point clear to all of you? So that is precisely the point of time when the survey will have to be undertaken, after sunrise but before sunset. Now in this case, please understand, the after sunrise before sunset, it is only the point of entry, which means that you have to enter at this, between this point of time. You can exit even after the sunset is over. So therefore exit can be after the sunset, but the entry is very critical in this case. So please take a note of it. TDS and TCS, for that compliance purpose, if the survey is sought to be undertaken, then the time when you need to enter the premises would be after sunrise before sunset. And generally if they tell you charitable place, charitable trust, that particular place the survey is sought to be undertaken, then again after sunrise but before sunset. Now what about any other place of business? It has to be between during the business hours. I hope that all of you are clear with this one. Places not to be entered where you are not carrying on the business. Okay, if in this case business of a residential premises of the third party, but if you are doing the business in your own residential premises, in your work from home, in your own residential premises, if you are doing the business, in that particular case, whether your residential premises, can that be considered for survey purpose? Answer is yes. But if you are doing the business in someone else premises, in third party premises, then whether you can undertake the survey in that third party premises? Answer is no. Okay, so therefore that is what it is, students. It is to be considered. Now the most important part over here, right of the income tax authority in this case, is that in the survey also, just like section 131, they can impound the books of accounts. They can impound the books of accounts, students, for 15 days. And if it has to go beyond 15 days, then in that situation you will have to take the approval from the higher authority. But during the survey, can the asset or the valuables, can that be seized? Can the assets and the valuable, can that be seized in the survey? Answer is no. Answer is no, students. I hope that all of you are clear with this one. Now tell me, in this situation, if you are doing TDS and TCS, the survey is for the purpose of TDS and TCS, then what is the time when you can enter? Students, what is the time that you can enter? After sunrise but before sunset. After sunrise and before sunset. I told you already for TDS and TCS this particular point. Okay, to after sunrise before sunset. Can the books of accounts be seized? If I want to do the survey to check the compliance of TDS and TCS, can the books of accounts, can that be seized? Answer is no, it cannot be seized, students. It cannot be seized. So even these questions are there in the MCQ. These questions are also there in the MCQ, isn't it? And that exactly is the point. Now 133B, students, is another particular section that you should be careful about it. Now 133A is a survey, whereas 133B, they will never use the word survey. What they will use the word is the power to collect the information. They want to collect the information, students. That is what section 133B will be all about. Now in this case, the authority, good evening Siddharth, in this case the authority who can exercise the power is assessing officer and the income tax officer in this case, and they can undertake the they can proceed to which place? The place of the area assigned to him, if it is area wise jurisdiction, and if it is a person wise jurisdiction, then the place which is occupied by the person. But please ensure, students, 133B, the word survey is never mentioned. Okay, now in 133B, students, what is the difference in this case? The first and the most important difference in 133B is that you don't have to take a approval from the higher authority, unlike in the case of 133A of survey, where the approval from the higher authority is necessary. In 133B, the approval is not necessary. Thereafter, students, no books of accounts shall be removed from such place. That is another most important distinction. No books of accounts can be removed in this particular case. Now, what is the point of time, students? What is the point of time when the authority can exercise the power under section 133B? What is the point of time? when the authority can exercise the power under 133B. So therefore, during those hours at which such places kept open to conduct the business. So in 133B, students, be careful. There is no thing of after sunrise or before sunset. It is during the business hours. So let's try to conclude the time when the entry can be made. Point number one, if it is 133A survey and you want to conduct the survey in that event or the function, then the time when you can enter is after the event or the function is over. In 133A, if you want to do the survey in the business premises of the SSC, place of business, then during the business hours. And last but not the least, under 133A, if you want to undertake the survey at any other place, then it is after sunrise or before sunset. You need to enter that premises. For the purpose of checking the compliance of TDS and TCS provision, if you want to do the survey under 133A, in that case, when you need to enter the premises, again after sunrise but before sunset. After sunrise, before sunset. 133B, which is not a survey, we will never use the word survey in 133B. What is the time to enter the premises, or which is the place of business? That is during the business hours. During the business hours. That is for 133B. For TDS and TCS provision, can you impound the books of accounts? Answer is no. For other survey 133A, for other survey of 133A, can you impound the books of accounts? Answer is yes. What is the period? 15 days. Can that be extended? Yes, but after the prior approval from the commissioner. 133B, can you impound the books of accounts? Answer is no. You cannot impound the books of accounts. I hope that all of you are now clear with this one. So that is all about the survey point, students, that we have discussed, and this is what has been targeted in your various MCQs question. You also are aware, we have discussed earlier also. So this is what primarily is the point. Now the search provisions, there has to be the top authority. Who are the top authority? The director, commissioner, joint director. These top authority should have a reason to believe. Reason to believe on what? Reason to believe that there is an undisclosed income. Reason to believe that the person has got undisclosed income. So therefore, their person has got undisclosed income. This is precisely what? This is precisely what is the reason for the purpose of doing the survey. Now, if you see the power, as far as survey is concerned, the most important power, students, is only this one. They can seize any books of accounts, money, bullion, jewelry, or other valuable article. That is the one of the most important power which is available. Seize what? The books of accounts, money, bullion, jewelry, or valuable article. But if the money, if the bullion, jewelry, or valuable article, students, be careful over here, huh? This is important. In this case, if the stock in trade, if this money, bullion, jewelry, or valuable article, if they form as a part of stock in trade, if they are a stock in trade, students, so just check this one out. If it is in the nature of cash, then cash can always be seized. Even if it is like in a money lending business, cash is a stock in trade. So can that be seized? Answer is yes. But if you are talking about any bullion, jewelry, or other valuable article, any money, bullion, jewelry, or other valuable article, it cannot be seized, students. It cannot be seized. Apart from that, students, there are three boxes: deemed seizure, constructive seizure, provisional attachment. Just only understand one particular thing. Only one thing, students, one box should be sufficient now at this particular point of time. Deemed seizure is what? When it is not practical to physically take the possession of those article or the asset of the SSC, when it is practically not possible to take the physical possession of those particular assets or the article or the valuable. In that particular case, what happens is that they will pass an order, and through that order, these assets or valuables are deemed to have been seized. And once it is deemed to have been seized, that person, although that person still continue to have the possession of those particular valuable or that particular asset, but he is not allowed to part away those assets or the valuables unless he has taken the prior approval or the permission from the authorized officer. Unless he has taken the prior approval or the permission from the higher authority. That is the case of deemed or the constructive seizure. That is what only now need to be known by all of you. This is very important. Presumption in the case of search and seizure. Now, what is this, students? The burden of proof is now on the SSC. Through this particular provision, the burden of proof is now on the SSC. What is the burden of proof? That whatever is found in your premises, whatever documents are found in your premises, whatever assets are found in your premises, whatever handwritings and the signatures which we find in your premises, we will presume to be belonging to the SSC. We will presume that it belongs to the SSC. So that presumption is made that it belongs to the SSC. However, now the SSC will have to establish what? That it does not belong to him. The SSC will now have to establish what? That this does not belongs to him. This is one of the most important presumption, students, that has to be considered over here. I hope that all of you are clear with this one, isn't it? Now, in this particular case, students, 132A is the same thing, students. Only one difference, students, of 132 and 132A is what? In 132A, there is a requisition. Requisition is made in 132A, and as per this requisition, what happens? What happens over here in 132A is that there is some other officers, say under the customs law or under the GST law, they may have done the search in the premises of the SSC, and the books and the other valuables are being seized by those customs or the GST officers. After that, the income tax authority also came to know that the SSC has got undisclosed income. Now, can they do the search? Answer is no. And therefore, they will appoint the authorizing officer, which is the director, commissioner. These authorizing officer, they will appoint requisitioning officer, and by appointing the requisitioning officer, these requisitioning officer will give the notice to whom? To that other authority. In that other law, they will give them the notice stating that after your proceedings are over, after your inquiry is over, kindly hand over the books and the asset to us. That is what 132A is. But what you do in 132 and 132A in terms of the assessment, that is the same. What you do in 132 and 132A in terms of the assessment, that is the same. Now, this is an important particular section, students, which has been there. And very popularly, this has been targeted in many of the attempts. 132B, application of the seized asset. Now, students, application of the seized asset. In this particular case, students, if the SSC premises is searched and the assets are being seized, can the SSC make an application and ask the officer to release the seized asset after adjusting estimated liability which may arise in consequence of search? Can an application be made by the SSC to the officer to release his asset after adjusting what? The estimated liability that may arise in respect of the assessment in consequence of search. Can that application, can that be entertained? Answer is no. Such application, students, will not be entertained, because 132B says, what it says, that the seized asset can be applied for what purpose? Students, be careful. First is any existing liability. What is existing liability? Like already there is a liability, say for example, in the course of assessment of 143 or 144, there is already an existing liability. So the seized asset can be adjusted against the existing liability. That is one. And second one is what? The liability which is determined on completion of the assessment in consequence of search. In a simple word, assessment in consequence of search. The liability which is determined in the course of the assessment, the liability which is determined in consequence of the assessment in the course of the search. That is it. So therefore, making an application and asking the SSC to adjust the seized asset against the estimated liability that may arise in future on the basis of the assessment, that application cannot be entertained, because the seized asset can be used only for adjusting towards the existing liability and adjusting towards the liability which is determined on the completion of the assessment in consequence of search. Now students, this is also an important provision sometimes targeted in theory. What is that, students? Over here, release of the seized assets and the books of accounts. Now students, I told you earlier also, just quickly I'm repeating this point again. What can be seized, students? What can be seized is only the assets. What can be seized is only the assets which are represented as undisclosed assets. So assets which are undisclosed assets, only those can be seized. So tell me one thing, students. A question was targeted in an earlier attempt where they have said that after the search is conducted, the assessee makes an application to the assessing officer and he wants that the seized assets should be released. The seized asset should be released. Can such application be made, and what is the procedure? Can such application be made, and what is the procedure? So the answer is, can such application be made? Answer is yes. And what is the procedure? We will discuss it now. So after search is over, the assets are seized. Then after the search is over, the asset is seized. Now the assessee wants to make an application for release of those assets. Can such application be made? Answer is yes. What is the procedure? Please have a look. The procedure is this, students. If the nature and source of the asset is explained, which means what? If the assessee is in a position to successfully explain to the assessing officer that, look boss, this is actually from the tax paid income that I have acquired the asset. At the time of search, I could not explain to you properly because I was not in my senses, because I didn't know what was happening, so I could not say anything about it. Now that the search is over, I have regained my senses. Now I am in a position to tell you the nature and the source from where I have acquired these assets, and you will be satisfied that these assets are being acquired from tax paid income. So if the nature and the source are being explained, then the assessee should make an application to whom? To the AO, and the application should be made within 30 days from the end of the month in which the asset was seized. So it should not be later than that. The application should be made within 30 days. Now once the application is made, what the AO will do? AO will first recover the existing liability. What the AO will do? He will recover the existing liability. What is the existing liability? I already told you the existing liability. Like already, if there is a pending liability from regular assessment, say for example 143, 144, so they can do the adjustment of that particular liability against the seized asset. Then the AO will take a prior approval from the commissioner, and then he will release the asset. So that release will happen only after the adjustment of the existing liability. But in the case where the assessee does not make any application, it should be understood that these are the undisclosed assets, and when that will be released, students, that will be released after the assessment in consequence of search is completed. That will be released after the completion of assessment in consequence of search. So that is the time when it will be released. Books of accounts, also a theory is asked. When the books will be released? The seized books, when they will be released? So they have said that it should be released, students, within 30 days. Within 30 days. 30 days from what, students? This books of account should be released within 30 days from what? The books of account should be released within 30 days from that particular assessment completion. From the date when the assessment order has been passed. Okay, so within 30 days from the date when the assessment order is passed. But if supposingly the AO still wants to retain those books of accounts even for a period beyond 30 days, then please take the prior approval. Okay, so that is what, students, it is, and that covers your search and seize, all the power of Income Tax Authority. I hope that all of you are clear with this one. Every one of you. Fine, students. All of you are clear with this one. So your Income Tax Authority power is completed, students. Just remember one more power, which is this section 142(2)(a). You all are aware this is about the special audit, and this 144(a) reference to the Joint Commissioner. So this is about the special audit. Quickly, I'll just take you through to this particular part, special audit, and one is the reference to the JCIT, Joint Commissioner. So students, in the case of special audit, what happens, as you all are aware, if during the pendency of the proceedings, the assessing officer is of the opinion that having regard to the complexity of the books of accounts, nature of the assessee's business, volume of the documents, and the fact that it is prejudicial to the interest of assessee, if this is a reason which the assessing officer is not in a position to complete the assessment, he is badly stuck in between. In between means during the pendency of proceedings, these are the difficulties that the assessing officer is facing: the nature of business, the complexity of the business, the volume of the data in the account, and more important is the fact that it is prejudicial to the interest of revenue. Then he can make an application to the commissioner and seek a direction for what? Direction for the special audit. Okay, now obviously students, the direction of the special audit, in this case the CIT will have to give the direction, will have to pass the order. And more important point, students, is this, that this direction of special audit, in that case the cost of special audit has to be borne by whom? By the central government. Sachin, level would be, don't worry, it will be in average paper. Students, one important point I should tell you immediately, which when you tomorrow you attempt the paper, I must tell you students, please don't take the MCQ, also don't take your question number 1. Very quickly I am reminding you this point again. The first 15 minutes, students, that you are going to get it, my humble suggestion to all of you would be, just use 2 questions, select 2 good questions that you can attempt peacefully. Select those 2 questions. Once you can select those 2 questions, which you know 3 questions are there, na? A, B, C. In every question 3 questions are there. If you know 2 questions properly, that is the best question. So that way you should select those 2 set of questions that you should attempt first. Do it decently. Then check out question number 1 primarily in this case, and in question number 1 just check that first paragraph of question number 1 and the last line of the question number 1. First paragraph, total income, that is a compulsory question. Generally it will be alternate tax regime, or maybe from the MAT, or the normal total income computation, which is normal, which is not difficult. The problem is that when we attempt that question number 1 towards the end, we make a mess out of it. So try to consider question number 1 as a third question, and by taking that as a third question, students, what you should do immediately, first paragraph and the last paragraph, you just read it out and then start attempting question number 1. And please ensure that adjustment, the notes of the adjustment should be written immediately below this, and leave one line and then write the next adjustment, leave one line and then write the next adjustment. Don't draw those lines and all, though that is not required. Simply particulars, amount and amount, that is sufficient, and that is how you should take it further in this context. Okay, that once these 3 questions are done, then you see the MCQs. Now in the MCQs also, in fact, I must tell you, you should quickly glance it and just check it out whether these are the theoretical and small MCQs or integrated case study, which are small, which is not much calculative, which you should try to attend that thing first. And later on, students, if there is a big MCQ, students, try to avoid it initially. Big MCQs, leave it towards the end and try to jump for the remaining descriptive questions. So the big integrated case studies, you should try to avoid it altogether and try to attempt that towards the end. Instead, you will be better off by doing the remaining descriptive question. Whichever questions that you know the best, try to solve them, because in the process of reading the unknown, it should not be at the cost of the known. Are you getting this one? In the process of reading the unknown, it should never be at the cost of something which you know. So say for example, question number 6, I know only one question but I know it properly. Try to get that question number 6, leave that half page and then write that question that you know it properly, and then leave the next page and then move on to the next question. That way you attempt those known questions properly and then come to that unknown MCQs which are being there towards the end. Okay, unknown big MCQs, integrated case studies, which you think it is an unknown area, territory, don't venture out, students, unnecessarily, and try to do those questions first which you primarily know the best. I hope that all of you are clear with this one. So strategy, first 15 minutes, 2 questions other than question number 1. So any two descriptive question, try to pick up that, whichever you know the best. Then hit the question number 1, first line, last line, first you read that, first paragraph and the last paragraph, first you read that and get started with this. Whatever the best. It is possible. Students, I'm telling you, in question number 1, there would be 3 to 4 adjustments which you may not know. Don't worry about that. Stepwise marking is given to that. Okay, so you, whatever adjustment that you know it properly, you have to do it, do a justice to that. Also write the notes to that adjustment, whatever is given to you. Just do the justice. At least whatever adjustments the marks are being given, you are going to get those marks on that particular occasion. Those adjustments that you are not sure about it, leave it, or maybe do whatever the best that you can do it, but don't worry much on that, because there are stepwise marking which are allocated for every adjustment. Now coming back to this one, students, in this context. So 132A, students, who will be the one who have to bear the cost of the audit? It has to be borne by the central government. Now be careful, there are 2 important points. Point number 1, if students, if the materials, the assessee needs to cooperate to the special auditor, and if there is a failure to cooperate to the special auditor, then automatically the case will go to the best judgment assessment. If there is a failure to cooperate to the AO in the course of the assessment, then directly the matter will go for 144, which is the best judgment assessment. So therefore, once the audit, the assessing officer will have to give an opportunity of being heard to whom? To the assessee. Only then this particular materials can be used. I hope that all of you are clear with this one. This is what 142.2a is all about. Next point is the JCIT, students. Now again, the reference can be made. Now JCIT, students, for giving a direction to the assessment, an application to the JCIT can be made. For giving the direction of the assessment, the application to the JCIT can be made. Now the application can be made by the assessing officer himself, or the application can be made by the assessee, or it can also go to suo motu. Students, suo motu also, the JCIT can give the direction to the AO. Suo motu also, the JCIT can give the direction to the AO. That is how, students, that is how the applications can be made so far as the JCIT is concerned. Once the application is made to the JCIT, students, what happens thereafter? The JCIT will give a direction, but be careful, there is an important point. If these directions are prejudicial to the interest of assessee, if the directions are prejudicial to the interest of assessee, then first, before using the direction, the assessing officer will have to give an opportunity of being heard. That is the only point, students. And now with that, we do this reassessment part, students, of section 147. The reassessment, students, of section 147. Now income escaping assessment, students, in this particular context. Now in this context, students, as far as the income escaping assessments are concerned, all of you ready with this one? A complexity of question, don't worry, you know it, you don't know it, just leave it across it. Don't worry much on that. Any case, students, it is effective attempt on direct tax paper is always around 80 marks or so. So don't worry much on that particular part about the complexity or difficulty. And please understand one thing, if it is a difficult paper for you, then it is a difficult paper for across all the students in India. So it's not only you who are on the receiving end. So just keep that particular position clear in your mind. Okay, students, so therefore now in this context, students, let's come to this 147, students. In this situation, 147 on the reassessment part. So students, over here in this particular context, the reassessment part, students, as you all are aware, in this context. So before, students, as you all know, the assessing officer, students, what can he do? He can, students, be careful. The assessing officer, if he is of the opinion that the income chargeable to tax, the income which is chargeable to tax has escaped assessment, the income which is chargeable to tax has escaped assessment, chargeable to tax has escaped the assessment, then in that case, students, what the AO can do quickly, income chargeable to tax, then the AO will give the notice. Income chargeable to tax has escaped the assessment, then in that case the notice will be given. Notice will be given to the assessee. Just the notice, students, will be given to the assessee. Okay, now in the context of this notice, students, in the context of this notice, Now in the context of this notice, students, what is the point? So income chargeable to tax. Now AO can assess, students, AO can assess such income. Such income, which income? Such income means what? The income which has escaped the assessment. And also, students, and he can also assess any other income which comes to his notice, any other income which comes to his notice subsequently. I'm just writing the word subsequently. Subsequently, during the course of section 147. So I'm just, students, writing the abbreviation part in this case. So the AO can assess such income or any other income which comes to his notice subsequently during the course of section 147. Okay, so this is what it is, students. Now this notice which we are talking about it, students, here in this case, notice is under section 148. That he will give it to whom? To the SSC. But before giving the notice, students, before the notice, an inquiry has to be made. Before the notice under section 148, students, as you all know, students, what happens? There is an inquiry under section 148A that has to be made. So in this case, students, this inquiry, students, in this scenario, what will be the situation, students? This particular inquiry, students, will be giving an SSC a notice under 148A. That is the first one. Thereafter, giving the SSC an opportunity of being heard, OBH, opportunity of being heard. Then prior approval has to be taken. Prior approval, students, has to be taken from the authority. All of you agree to this one? Then he will take a prior approval from the authority. And then after considering the reply, after considering the SSC's reply, students, what he will do? After considering the reply, what he will do? He will decide what? Whether it is a fit case or not. Decide on the two things in this situation. So therefore, in this situation, he will consider two things. Either will pass an order to issue notice under 148, or not to issue the notice under 148. Isn't it? That is the kind of an order that will be passed in this context, students, in this regard. So this is what it is. Now once he passed the order that yes, it is a fit case for 147, notice under 148 will be given. Now in which case, students, can you tell me, students, in which particular case the notice under 148A or the inquiry of 148A is not applicable? You all are aware 148 is not applicable in the following case, students. Which case? You should be aware of it. The case is that of 132 and 132A. 132 and 132A, students. 132 and 132A. One more section, students, is there. Just you remember this section. In fact, just for the reference purpose. 132 and 132A. For this particular cases of 132, 132A, or because of 135A, if he wants to do the assessment of 147, for these particular cases, he will not be required to do the inquiry under 148A. Immediately he can proceed with notice under 148. Immediately he can proceed with the notice under section 148 and he can start the assessment. But what about survey, students? If on the basis of survey under 133A or the information which is collected under 133B, if on that basis they want to do 147, can they do it, students? Can they do it? Answer is yes, they can do it. 147. Will they have to give the will they be required to do the inquiry under 148A on the basis of the survey of 133A or 133B? Answer is yes. The exemption of 148A is only for 132, 132A and 135A, not for the survey or any other power on the basis of which they want to do 147. For those cases, the exemption of 148A is not available. So just keep this particular point in mind, students. Now, in this context, students, so students, over here, primarily, one thing I told you, students, one of the important point. So Notice. Now after that, issue of notice. Issue of notice under 148. Now when you talk about the issue of notice under 148, students, if you see in this case, the notice is served notice is served on the basis of students, two things: information in possession of the AO, or deemed information, students. Now this is important. Now what, students? Deemed information, students. Deemed information. Now which are the cases of deemed information, students, in this particular context? So the deemed information, students, in this particular context is that of again, now here the list is students for what? The list is, students, in this particular case is 132, 133, 132A, 133A. Now for survey also, they have deemed to have the information. They have what, students? Deemed to have the information in this particular context, that's a deemed information case. So 132, 132A, 133A. These are the cases of deemed information. In this regard, this is a case of deemed information, students, in this regard. Now this deemed information of this particular case is for 3 years. Deemed information for this case, the income escaping assessment is 3 years. So deemed information, students, is 3 years. Automatically it is deemed that if the assessment of 147 is conducted in consequence of 132, 132A or 133A survey, then it is deemed that the AO has the information for the 3 years prior to the year in which the notice under 148 is given. So for the last 3 years, there is a deemed information that the income of the SSC has escaped the assessment. Income of the SSC has escaped the assessment. So automatically, students, what happens? If they want to do assessment under 147 because of 132, 132 or 133A, then automatically they have got the power to do the assessment under 147 for the last 3 years. Automatically, because it is deemed that they have the information for 3 years. So that is the point, students, over here. It is deemed that they have the information for 3 years. Whereas for all the other cases, students, for every year, it is to be considered on merit. That, okay, for this year, do you have the information that the income has escaped the assessment? If yes, give the notice. Give the notice under 148. So that is how the things will be considered. So students, this is how it is the case. Only one point of distinction, students, that arises over here is that although the deemed information is also considered on the basis of survey of 133A, although the deemed information is considered on the basis of survey of 133A, but for the survey, if you want to do 147, then please tell me whether the notice under 148A, which is the inquiry of 148A, is it mandatory? Yes. For survey, there is no exemption. The exemption of that inquiry under 148A is only for 132 and 132A. Is that clear to all of you? But deemed information is for all the three. Deemed information, students, is for all the three. I hope that this point is well taken by all of you. Now with this particular point, students, the time limit. The next one, students, is the time limit of issue of the notice. Time limit of issue of notice, students, in this case. Now, time limit of issue of notice, students, goes under 149. And what is the time limit? You should be aware of it. There are two time limits. 3 years is the normal time limit in this particular context. So therefore, students, in this particular context, so in this situation, the normal time limit is within, this is the normal time limit. So what is the normal time limit? Within 3 years from the end of the relevant AY, from the end of RAY, relevant AY. And if supposingly, students, if supposingly what? if the income which has escaped the assessment is represented by the asset. What is asset, students, in this particular context? Asset, students, would be the land and building, the shares and securities. In this context, loans and advances. So if the income which has escaped the assessment is represented by the asset, representing as land and building, shares and security, or loans and advances, which is exceeded or likely to exceed rupees 50 lakh, greater than or equal to, students, rupees 50 lakhs. Rupees 50 lakhs in this case. Then in that situation, students, then the notice can be given within 10 years from the end of the relevant ABI. Okay, so that is what it is, students. I think all of you are aware of this one. Income escaping assessment. If that is the case, then this is what it would be the point. The last point, students, is about the approvals. There are 2 points, students, only that is left. Approval, family approval, students, that has to be taken. So approval depend upon when the notice is given. If the notice under 148A, if the notice under 148, students, is given within, is issued within 3 years or after 3 years, then what happens, students? If it is within 3 years, students, then the approval that has to be taken is from whom? From the PCIT, Principal Commissioner of Income Tax, CIT, or the JCIT, as the case may be. Whereas if it is after this thing, then Principal Chief Commissioner of Income Tax, CCIT, or Chief Commissioner of Income Tax, as the case may be. Students. So therefore, in this case, this will be PCCIT or CCIT, as the case may be. So that is what it is, students. So therefore, last, students, is a time limit to complete the assessment. Time limit to complete the assessment of 147. Time limit to complete the assessment of 147, students. What is the 12 limit, students? You all are aware. 12 months from the end of the month in which the notice under section 148 is what? Is served. This is the most important point, students. All of you are aware of this. Served. I think I have already discussed with you some MTPs also earlier. You all are aware of it. I have discussed with you, students, the MTP. So served is important. So say, for example, let me recall that MTP question with all of you. That MTP, MTP question with all of you. So the notice was issued on 31st March 2022. The notice was served. When it was served? It was served on 1st of April 2022. Now you tell me, students, the time limit. So when you have to complete the assessment, 12 months from the end of 12 months from the end of the financial year. 12 months from the end of the financial year in which the notice under 148 is served. So plus, so which financial year, students? This is which financial year? Financial year 22-23. So from financial year 22-23 plus 12 months, which comes to 31st March 2024. See the difference. I hope that all of you are clear with this one, students. Every one of you. Yes, students. All of you are correct in this particular context. I hope that all of you are clear. I think all of you are getting the answers right. Very good, students. Perfect. Excellent. Now, students, do you want to refer any MCQ question, or directly now we can move on? I think all of you are writing. I think, students, you should not have any worry. Now all this question we have done it earlier also. Same thing again and again, we'll repeat it. In this case, I think let's move on, students. I think I've covered even the small MCQ point. You already have witnessed it. So there is no point in reading these case studies and all, which we already have done it. Can we move then, students? Family, with all of your permission. Don't worry, because these I've captured in my discussion. I have captured in my discussion these case studies also. Okay, so I don't think now there is any point for us to simply run through these case studies again and again and just to get ourselves have a false satisfaction. So let's not have a false satisfaction. Now the time has gone for these false satisfaction and all those stuff which otherwise we always used to do. Now I have considered it, students, all the things. Students, have you done AAR and DRP, dispute resolution panel? If not, then quickly I will just run through the question and answers of that particular AAR and DRP. Have you all done that, students? Just let me know quickly. Quickly, students. Tell me if otherwise I'll make a hit, students. Done. Let me quickly run through this one in this particular context, Bhanu. Once quickly, I'll just run through only the question and answer for this one. Q&A. On the basis of the Q&A, students, just here I'm not entertaining this particular part. Students, in the DRP, the dispute resolution panel, only you have to focus on what? The two things. Which is that two things, students, in this particular context? We need to focus, students, only on this particular two things, and on that basis only the question will be there. So the two things, students, which has been there over here so far as the DRP is concerned, this is the particular point, students. So small SSC only will be getting this one. Please understand, small SSC only in their assessment. First of all, students, their ROI, students, their ROI that they have filed, the ROI condition, students, ROI condition is up to the total income. In the ROI, up to the total income up to rupees 50 lakhs. Plus, the AO has made the adjustment. AO has made the adjustment. Adjustment of how much? Up to rupees 10 lakhs. Up to rupees 10 lakhs. And this adjustment, student, that he has done is not on basis of this. AO has not made the adjustment on the basis of this 132, 132A, or even that survey 133A or 90, that information sought from the other country, and that tax exchange information from the other country 90 and 90A. So this adjustment of up to 10 lakhs is not because of the information which the AO has got on account of 132, 132A, 133A, which is the survey that they have covered, and the last one, students, is this 90 and 90A. Okay. At the same time, this person should not be a serial criminal. The person should not be having a criminal background. Now, what is criminal, students? Criminal should not be a criminal. You should not write criminal in the examination primarily, but nevertheless, the kind of violation is like a criminal violations. Which violation, students? Detention under the foreign exchange and smuggling offense, narcotics, IPC. So he has been having the prosecution, detention under the narcotics and all, or corruption or money laundering, these things which are being there, narcotics or drug substance, or the prosecution primarily which is under the provision of this act or the Indian Penal Code, or under any other law for the time being in force. Prosecution, students, prosecution. So he should not be prosecuted under any other thing, or special court. Just keep those in mind. So criminal background. So therefore, then only you are eligible to make an application to DRP. And if you make an application to DRP, ROI condition variation in the total income by the AO up to 10 lakhs. Those two conditions also to be seen, and that variation should not be on the consequence of 132, 132A, 133A and that 90 and 90A. Is that point clear to all of you? And that's exactly what it is, students. I hope that all of you are clear with this one. So that is it, students. This covers up your DRP. The question is based on that only, so you need not primarily refer in this particular case. So this is what it is, students. Just over here, students, I just want to read this much of the paragraph, only this much paragraph. Without knowing the question, the beauty is without knowing the question, I'm just reading the paragraph for all of you. All of you. Accordingly, in the present case, Mr. Vijay can file an application before DRC since the assessment order is received on 26th of June 2022 is a specified order, and he satisfies the specified condition on account of no order of detention being made and no prosecution proceeding being initiated. So neither detention nor prosecution. This is the wording that you have to write in the theory. So what you're going to write in the theory, there is neither a detention nor there is any prosecution. Now students, if supposingly a penalty has been levied under the income tax law, if a penalty has been levied under the income tax law, will this be considered as ineligibility? Will this be considered as ineligibility for making the application before the DRP? Answer is no. It is not an ineligibility to make an application before the penalty is not. Detention and prosecution. This will create what? The ineligibility. Detention and prosecution, but not the penalty. Now, in this case, with the DRP, students, what is the time limit by when you need to file the application before the DRP? So the application, students, should be filed within 1 month from the date of receipt of the specified order. What is specified order? In a simple word, assessment order. In a simple word, students, assessment order. In this case, so within 1 month from the date of, students, it is the data, not the end of the month. Within 1 month from the date of the specified order, the application for the DRC should be filed. I hope that all of you are clear with this one in this particular context. So within 1 month from this date, 26th assessment order was passed on this date. So by 25th of December, so within 1 month would be 25th of December, you will have to pass this particular, you will have to make an application. DRP is over, students. DRP is over. So therefore, now in this particular context, students, now comes the AAR. As AAR is concerned, students, in this case, again, I will just quickly run through this particular part of the AAR in this context. Now, students, the application which you will see AAR, the application is made by the non-resident himself, or even the resident can make an application to determine the proposed liability of the non-resident arising out of this transaction. So even a resident can be an applicant to determine what? Determine the proposed liability of the non-resident. So who is the applicant? Non-resident can be the applicant. Even the resident can be the applicant to determine the proposed liability of the non-resident arising out of the transaction. The third applicant is the notified resident. Now the notified resident, students, is one is the PSU. PSU without any limit of amount. Third applicant is the PSU, and one more particular PSU is the notified resident, and any other resident for themselves, if they have to find out the liability from the AAR, if they want to find out the liability from AAR, then that applicant should have at least what, students? The transaction value should be more than or equal to rupees 100 crores. So if the transaction value is more than or equal to rupees 100 crores, then yes, even that resident for its own case, see, understand, in point number 2 also the resident was an applicant, but it was for non-resident that the application was being made. Whereas over here, students, in this particular case, in this case, the resident here, he wants to make an application for his own case. Only condition is that the transaction value should not be more than rupees 100 crores. Should be more than or equal to 100 crores. Fees part, students, sometimes they ask the question on the fees part also, but you can skip this particular point. now it's a time, it's not something that we should be looking into the fees part. Difficult in this case, unnecessarily we will be into it unless you have done it or bahated it earlier. Is the application which you have given to AAR, can that be withdrawn? Yes, it can be withdrawn within 30 days. This is also an important question. It can be withdrawn, students, within 30 days. Now, students, one particular point. What is the ineligible? Students, be careful on this one. What is the ineligible case for which the application cannot be made? This is again a very important question as far as AAR is concerned. So for the notified resident, which is a PSU, for the notified resident, which is the PSU, only one matter. What is the one matter? PSU. If PSU is the applicant, then only on one case it is ineligible. What is that? To determine the fair market value of the property. Whereas, students, be careful, for all the other cases. Which are the other cases? 3 cases. Non-resident. Second is the resident, but for non-resident. And third one is the resident for himself when the transaction value is at least 100 crores. So in these 3 cases, the ineligible case would be when the case is pending before Income Tax Authority, ITAT or the court, if the case is already pending. Second, FMB, whatever is there, FMB, for that purpose also the application cannot be made. And point number 3, students, very important, is it relates to a transaction or issue which is designed prima facie for avoidance of tax. So if the transaction has been designed prima facie for avoidance of tax, then for that matter also you cannot, means structuring and all, so for that matter also you cannot make an application before the AAR in this case. So this is what is the point, students, which has been there. Now one very important point, students, is this, that whether the application, can that be challenged, when whether the AAR order, can that be challenged, students? You all are aware of it. Whether the AAR order, now we are supposed to refer this as Board of Advanced Ruling. AAR would be referred as Board of Advanced Ruling. Now, can the pronouncement or the ruling of advanced ruling, can that be challenged? Answer is yes. Now, students, it can be challenged, and in this particular case, it can be challenged before whom? Before the High Court. Earlier, it could not be challenged, students, in this case. Now, students, in that case, it could be challenged, and the challenge has to be, students, where? It is before the High Court. Now, it may be appealed, students. This is the important point. It may be appealed to the High Court within 60 days from the date of communication of that ruling. This is what you have to write. Within 60 days from the date of communication of that ruling. So here 2 time limit you should remember. In AAR, 2 time limits you should remember. Which are the 2 time limits, students? Time limit number 1, 30 days. Within 30 days, the application can be withdrawn. And the second time limit is within 60 days from the date of communication of that ruling. Within 60 days from the date of communication of that ruling, can that particular order of BAR, can that be challenged? And the answer is yes, it can be before the High Court. With that, students, we are done with this particular part in this particular context. And what is the time limit, students, you will remember for dispute resolution? 30 days. The dispute resolution from the date of the order, within 30 days, you need to make an application before whom? Before the dispute resolution committee. So, students, we are done with this particular part also. With that, students, now I come to my next particular part. Now we are in time, students. I'm doing it well within the time. At the end, students, some students have said surrogate taxes. Students, one question I will do with all of you in the last of the session of surrogate tax, which covers your all surrogate taxes area. One question on surrogate taxes, which will cover up all your area of the surrogate taxes, students, in this case. So therefore, with that, now, students, let me come to the business deduction. Students, let me come to the business deduction. Now, in business deduction, and also I will touch upon the ICDS. So that is the second part. So let me come, students, to that particular part now. These things would become historical, students. If it turns up in the examination, then nothing like that. I'm just trying to complete this particular part, 8:30. Then you tell me, students, towards the end, what is remaining at your side. I'll just tell you how to wrap it up, family. And there is a smart way wherein we all know how to really wrap it up these things. Now, students, in this particular context, one theory, students, half an hour. I'll just put one video at night on this non-resident taxation at night, late night, students. I'll try to put a theory. Half an hour, you can just run through that particular theory, and that should be all. This deduction, students, is the profiting deduction. So, students, over here, apart from that, there is this 3617. So here, students, just keep in mind, PGBP, first of all, the profiting deduction, students. Students, this 10AA is one of the point that you should always bear it in mind. They can definitely use this, or even this ATIA, ATIB, ATIA, ATIB, or even this ATIAC. All these things can be touched upon by the ICI in the examination. First, you do this 10AA. It is equivalent that you are doing other profiting deductions also. And what is that, students? In this case, remember, students, yesterday we did 80JJAA already. We did the 80JJAA while we were doing that workman particular case. For that question that we were doing it, practical question on alternate tax regime, there itself I have revised with all of you this 80JJAA. So now coming to 10AA, students, over here, it is for export. So this is what you only need to consider it, students. In the question, just check it out, students. When that SEZ unit was being set up, the date is important, students, and check it out whether previous year 22-23, which is there, is it within that 5 years period or after 5 years period? Because if it is a 5 years period, then the deduction under section 10AA, by the way, students, this deduction of 10AA is on total income. This deduction of 10AA is on what? On the total income before this 10AA. So I must say that this 10AA deduction is the last deduction. This 10AA deduction is not from the PGBP, it is from the total income. So it's a last deduction, and finally after this deduction you get total income. Now this 10AA deduction, as I told you, either it can be 100% or it can be 50%. 100% or it can be 50%. Of what? Of the qualifying amount. Of the qualifying amount, students. Of the qualifying amount. Now this qualifying amount is what? In this qualifying amount, there are two factors. Which are those two factors, students? One is the export turnover divided by the total turnover. This is there. Okay, now export turnover, students, is what? Is the realized turnover. You all are aware? Export turnover is a realized turnover. Realized in the convertible foreign exchange. Realized in convertible foreign exchange minus in this turnover any realized minus any realized turnover minus any realized turnover in the form of what, students? In the form of what are those items? You should be aware of it, students. What are those items? The items, students, as you all are aware, in this case, the telecommunication charges, freight charges, insurance charges, or the technical services provided outside India. Telecommunication charges, freight charges, insurance charges, or technical service provided outside India. OI. I'm just writing all the in abbreviation form. So what are these? I'm repeating this point again. In that realized turnover, if there is any amount which represents telecommunication charges, freight charges, insurance charges, or technical service provided outside India, even that will be excluded. Okay, in the total turnover, there will be a domestic turnover plus the export turnover. Now this export turnover would be on accrual basis. Be careful. Now, but on this accrual basis, not on the realized basis, on accrual basis, students, what will be excluded? Again the same thing, TFI and this technical service outside India. And one more thing that will be excluded from this particular part is the taxes, students. Taxes also will be excluded from the domestic turnover. So the denominator is the total turnover. So this is your total turnover, denominator is the total turnover, and total turnover would mean the domestic turnover plus the export turnover. This domestic turnover will exclude the taxes, and the export turnover will be the accrued portion, and that accrued portion will exclude what, students? The telecommunication charges, freight, insurance, or the technical service provided outside India. But be careful, students, here you have to take the accrued portion only. because export turnover is taken as accrued portion. So therefore what will be reduced? What will be reduced also would be the accrued portion. What will be reduced, students, would also be the accrued portion. Do you all get this one, students? What will be reduced would also be the accrued portion, and that exactly is the point. What will be reduced, students, would be the accrued portion. Is that point clear to all of you? In the numerator, export turnover is a realized turnover in convertible foreign exchange. So what will be removed from that will be the realized turnover in the form of telecommunication, freight, insurance, or the technical service provided outside India. The realized, because export turnover is realized turnover. So the realized portion of telecommunication, freight, insurance, technical service outside India, that realized portion is what is to be excluded. Whereas in the denominator, the export turnover is the accrued portion. So it is the accrued portion of the telecommunication charge, freight, insurance, technical service provided outside India has to be excluded. Is that point clear to all of you? And that's exactly how the things has to be considered. Now this is all about the export turnover and the total turnover. Now comes the big thing. And what is that big thing? This is the point. Profit which is derived. Profit which is derived from what? From the eligible business. Profit derived from the eligible business. Now this is the critical word. The word is derived. This is the critical word, which is the word, students, herein. Two things. Yesterday, students, if you remember, in the alternate tax regime, we were discussing section 115BAB, and in that 115BAB, 15% rate has to be applied on the profit derived from the manufacturing business, the profit which is derived from the manufacturing business, and the incidental profit from the manufacturing business, incidental income from the manufacturing business. Now that incidental, if you remember, students, we have given the example of incidental. What is that example of incidental? Like the deposit made with the bank to furnish the bank guarantee for which the SSC will receive the contract. Then on that deposit amount there will be interest. Now that interest income will be considered as an incidental income. That interest income, students, will it be considered as an incidental income? And the answer is yes. So that interest income, students, definitely will be considered as an incidental income in this regard. I hope that all of you are clear with this one. So therefore in this case it's an incidental income. So although it is eligible for 15% under 115BAB, but a question which is to do with 10AA or even this ATIA, ATIB, ATIAC in any profit link deduction, because be careful, students, in all the profit link deduction, whether it is, now this is common for, this part is common for 10AA, ATIA, ATIB, ATIAC, etc. Common for all, isn't it? Only what is extra for 10AA is into export turnover divided by total turnover, and then you take 100%, 50% as the case may be. But for all the remaining cases of the profit link deduction, this only one thing is common for all. And what is that? Profit derived from the eligible business. So what did I told you, students? Any incidental income, those incidental income will not be a part of the profit which is derived. Will not be a part of the profit which is derived. Is that clear to all of you? What about the freight subsidy, power subsidy which has been given? Will this be considered as a profit which is derived? The freight subsidy or the power subsidy, answer is yes. It is very much a case of a profit which is derived. I told you earlier also, from the manufacturing till the time of sale or export, whatever are the elements from the manufacturing till the item of sale or export, all the elements are considered as a part of profit which is derived. All the elements are considered as a part of the profit which is derived. So power subsidy is for manufacturing, so therefore profit which is derived. Transport subsidy, it is before the point of sale, so therefore before the point of sale, the transport subsidy, if it has been given, accordingly we say that it is a part of profit which is derived. The other word of transport subsidy is octroi subsidy. The other word of transport subsidy is octroi subsidy. All this will be considered the profit which is derived. After the sale or export has happened, thereafter the SSC becomes eligible for duty drawback and other export incentives like import entitlement license, etc. So after the export is done or sale is done, that the SSC is eligible for these export incentives. So those export incentive, is it a profit which is derived? It is after the export, so it is not a profit which is derived, it is incidental business income. And if it is an incidental business income, will it form part of the profit derived from the eligible business? Answer is no, and hence no profit link deduction in respect of those incidental business income. But incidental business income, will this be eligible for 15% rate under 115 BAB? Answer is yes. Answer is yes, students. With that, students, this is the word derived, which is very important. The next one, students, the profit over here, be careful over here. In this case, the profit over here, students, is the computed profit. First point, as far as the profit is concerned, it is the computed profit. Computed profit therefore mean that supposingly if the assessing officer in the course of the assessment, if he is disallowing any expenditure of the eligible business, if he is disallowing any expenditure of the eligible business, and because of that disallowance the profit is increased, because of that disallowance the profit is increased, then whether you will be eligible for that enhanced profit, whether you will be eligible for deduction in respect of that enhanced profit, answer is yes. You will be eligible for the deduction in respect of that enhanced profit for sure. That is point number one. Point number two, students, which has been there in this case, because the profit is the computed profit. Second one, students, in this case, be careful, students, be careful. The second one, students, over here is this, that if at all there is any inter-unit transfer of goods and service, inter-unit means ATI, A Limited has got ATIA and non-ATI unit, and between them there is what? Inter-unit transfer of goods and services. Then for the purpose of determining the profit, the transaction between these ATIA and non-ATI unit should be accounted on the basis of the fair market value. For the purpose of determining the profit derived from the eligible business, to finally determine the amount of deduction, that profit should be computed having regard to the fair market value. In which transaction, students, I am talking about it? The transaction between ATIA and non-ATI unit. That is the point number two. And the last one, students, which has been there, which is this one, is an important one, students. And what exactly it is? Again, I will just take you through the year wise, students. Year 1, year 2, year 3 in this particular context. So year 1, year 2, year 3 and year 4. Students, just last one is important because that is also based on the recent Supreme Court judgment, and this judgment can be expected in your examination. So if I just quickly run through in next 2 minutes this particular point. So if it is a ATIA unit, A Limited has given you this data, ATIA, PGBP, ATI unit, non-ATI unit. So A Limited is giving you this information, and then thereafter there is IFOS income. So these ATI unit and non-ATI unit is PGBP, and then there is IFOS, then there is a GTI, and now after GTI, students, in this case chapter 6A, and finally after chapter 6A the total income. Consider this ATI unit as a 100% deduction which has been there in this context. Now students, let's have a look. So if it is say 120, IFOS is 10, this is minus 20, this is 80, this is 10, this is 30, this is 20, this is 5, and finally, students, finally this is 50, this is minus 10, and then thereafter, students, there is this 20. Okay. Students, before I proceed with this, students, there is a legal fiction introduced, which is introduced in computing what? Profit for the purpose of profit link deduction. Profit for the purpose of profit link deduction. PLD, profit link deduction. There is a legal fiction which is introduced for the purpose in computing the profit for the purpose of profit deduction. And what is the legal fiction, students? That legal fiction is that the legal fiction, students, is that the eligible undertaking, the eligible business means which is eligible for this ATI, ATIB, 10AA, etc., is considered as the only business of the SSC. Is considered as what? As the only business of the SSC, as the only business of the SSC, students. So that is what is the legal fiction. This is what you should just keep in mind. And now on that particular point, students, let's begin with this. The eligible business is considered as the only business of the SSC. So in computing the profit for the purpose of profit link deduction, in computing the profit for the purpose of profit link deduction. So that is a legal fiction that you have to always apply in computing the profit for the purpose of profit link deduction. Now coming to the first one, the GTI, students, is how much? 130. All of you agree? The GTI in this particular case, students, is 130. How much is the chapter 60 deduction which is there in this particular context? So the chapter 60 deduction, students, is herein is 100. ATIA deduction, chapter 60 means ATIA. Full 100 deduction will be given. 100 deduction would be given in this case, yes. So total income is 30. In the second case, students, the GTI would be how much? GTI, students, here would be 90 and minus 20, 70. See, for GTI we don't have any issue. For GTI, students, you will calculate normally. You will say, sir, but you are setting off the loss from the profit. I told you already earlier, students, this legal fiction is only to be considered not at the GTI stage. The legal fiction is not to be considered at the GTI stage. The legal fiction has to be considered at the chapter 6A stage while you compute the profit for the purpose of deduction. While you compute the profit for the purpose of deduction, at that particular point of time, you will have to consider this. So at the stage of GTI, you will go normally. And therefore, if you see over here, the GTI happens to be 70. Now with the GTI happens to be 70, students, chapter 6A, no deduction. Because at least we can say set off restriction in computing your GTI, set off restriction is only on the speculative business or the specified business of 3580. That's the only two business for which there is a set off restriction. Apart from speculative, apart from 3580 specified business, there is no other restriction. And therefore, your total income also, students, would be 70 in this case. Although, no chapter 6A. Let's come to the third year. The third year is important, students, over here in this case. In the third year, students, what it is? In this case, your GTI. How much is your GTI? 55. There is no brought forward loss as such at the GTI stage. Do we have any brought forward loss at the GTI stage? No. Because whatever loss was there was set off already. So there is no brought forward loss. So GTI is how much? 55. But be careful now, students, over here. Be very careful over here now, students. What I told you, profit link deduction. What is this profit link deduction? That is to say that the eligible for the purpose of computing the profit, the eligible business is considered as the only business of the SSC. And if it is considered as the only business of the SSC, you will focus only on that ATIA business. And if I am focusing only on that ATIA business, students, please tell me now. For this is the legal fiction to be considered only for purpose of computing the profit for the purpose of deduction under ATIA, ATIB, 10AA, etc. Now, therefore, I tell you in this case, how much is the amount over here, students? The amount that you can see easily is how much, students? Legal fiction. Now, the loss of the last year for the purpose of computing the profit. The eligible business is the only business. So, therefore, the loss of the last year will be set off against the profit of the current year. And therefore, by virtue of this, my GTI will be 55. Against that, I will reduce the profit. How much profit? Only 10 rupees I am going to reduce. And by reducing rupees 10, the net total income is 45. Now you tell me in the next year, students, over here, 55 is there. 55 students is there. Next, sorry, year number 4 now, students. Year number 4. Only GTI. If I have to calculate only GTI, GTI 60. GTI 60 students. Now in this GTI 60 students, legal fiction will be applied. Now if I apply the legal fiction over here, students, if I apply the legal fiction over here, how much will be the deduction? By applying the legal fiction students would be 50, and accordingly I will get a deduction of 50, and by virtue of that, students, in this case 10 is my total income. So apply the legal fiction, and on the basis of the legal fiction, 50 is what will be reduced in chapter 6A, and therefore 10 is finally the amount that will be there. Okay, last quick point, students. So this is precisely what you should remember. This is also based on a recent Supreme Court judgment, and therefore students, just keep this particular point in mind. So apply the legal fiction and get the answer. Now last point, students, which has been there over here is this. Students, one important point I just want to discuss with all of you. One last point, students. 80 ISC, students, 80 ISC is for the startup company. Which startup company? The startup company whose turnover is not more than 100 crores. The startup company whose turnover is not more than 100 crores. In that particular case, students, that particular startup company will be eligible for the deduction, and the deduction, can you see this, students? The deduction would be out of 10 years. Students, out of 10 years, they can choose any 3 consecutive years. Out of 10 years, they can choose any 3 consecutive years, and for that 3 consecutive years only, that the deduction would be allowed. For that 3 consecutive years only, the deduction would be allowed. Just remember for 80 ISC this particular point. So you have to choose the best 3 consecutive years. Now that best 3 consecutive years could be at the start, or it could be at the middle, or it could be at the end. Doesn't matter. This 3 consecutive years could be at the start, or it could be in the middle, or it could be at the end. So one question that they have targeted was, you have to decide which 3 years that out of the 10 you will choose, and you will choose that 3 years which will give you maximum deduction, and that exactly is the point. With that, students, we are done with this profit and deduction, and this is what, students, you are going to get it over here. So students, this has been done. Now you tell me, students, whether you want that 35 AD. I don't think so. 35 AD, students. I think you can wrap it up. I can jump into the ICDS now quickly, students. At the end, students, I will do this 35 AD and all. Those who want to primarily see this 35 AD and the other deductions of 3617A or so, I will do for them. Rest of it, primarily, if they have already done with that, they can move. ICDS part, students, very quickly. ICDS part, students, very quickly. I'll just run through that particular ICDS part. Now in the ICDS segment, students, in this context, in terms of the ICDS now, students, all of you, just keep this particular point in mind. So students, 8:30 is what primarily I'm looking at to wrap it up your session, 8:30. Okay, so therefore, let's now look upon to this ICDS particular point. Students, first of all, this ICDS number 10. ICDS number 10. Now students, first of all, ICDS you will not apply in MAT, book profit computation. ICDS has to be applied only in the total income computation. Or even in the alternate tax regime, there also you have to compute total income. In the alternate tax regime, there also you have to compute the total income, isn't it? So on those particular cases, you will apply what? The ICDS principles. But for book profit computation, ICDS will not be considered. Okay, that's one point. Now, as far as the provision for liability is concerned, ICDS 10 is the guiding factor, and ICDS 10 asks you 2 questions. ICDS 10 says that 2 things should be satisfied. If you want to, students, if you want to get the deduction of provisions, if you want to get the deduction of the provision, then satisfy 2 conditions. Which are those 2 conditions? The liability for which you want to create the provision, that liability should be certain. The liability for which you want to create the provision, that liability should be reasonably be certain. For provision for liability, provision for what? Students, provision for liability, what is the criteria? That the liability should be reasonably be certain. That is point number 1. And what is the next point, students? The next point is that it should be capable of being ascertained, ascertained, students. So that liability should be reasonably certain, and it should be capable of being ascertained. Capable of being ascertained means quantifiable. So if it is reasonably certain and if it is capable of being ascertained, then only you will get the deduction of provision for liability. If any one of the condition is not fulfilled, then in that particular case, what we will say that it is a contingent liability. And because it is a contingent liability, it will not be allowed to you as deduction. Whether contingent liability, is contingent liability allowed as deduction in computing the book profit? Is contingent liability allowed as deduction in computing the book profit? Answer is no. Yesterday we have seen in the context of book profit computation, contingent liability is not to be considered in computing the book profit. Also in the trust taxation, while we were calculating the accredited income, in the accredited income, fair market value of the asset minus the outside liability, that outside liability shall not include the contingent liability. Even in that, the contingent liability was out from the race, isn't it? Now, reasonably certain, students, you have to be very careful. Reasonably certain is used at multiple places. We will see family where it has been used. Even in the case of, students, I'll let you know family further in this particular context. Let's look upon to ICDS number now, students, over here. Let's look upon to ICDS borrowing cost, students. In this context, only one thing which is to be remembered. Just don't worry about the borrowing cost. We already have done it. In fact, yesterday, remember, one adjustment came of interest capitalization on that particular plant. That is nothing but the borrowing cost. Apart from that, students, it is not only about the interest. If there is any other cost in connection with the borrowing of the fund, like for example processing fees, they can also give you bank processing fee for obtaining the loan which was taken for purchase of the asset. So bank processing fee, will that also be capitalized? And the answer is yes. Now here, students, the qualifying asset for which the capitalization is to be done also involves inventory. Also involves what? In inventory. And that inventory should be inventory which takes what? 12 or more than 12 months for making them in saleable condition. Inventory is also considered as a qualifying asset, but only that inventory which takes at least 12 or more than 12 months to make them in saleable condition. That is the inventory on which if there is a borrowing cost, then that borrowing cost also would be capitalized to determine the cost of what? Cost of stock in trade. Cost of stock in trade. So in determining the cost of stock in trade. Other than that, qualifying asset is the tangible asset, which is land, building, machinery, plant, furniture, and the intangible asset, which is know-how, patents, etc. That is what it is required, and that is all of your ICDS number 9. ICDS number 8, students, as far as the security is concerned, just one important point that you should keep in mind so far as security is concerned, students. And what is that? Securities, ICDS 8 is only for those securities which are held as a stock in trade, not for the purpose of investment. Those securities which are held as a stock in trade, not for the purpose of investment. And please tell me, if any item which is held as a stock in trade, then how the valuation is to be done? Cost or NRV, whichever is lower. Cost or NRV, whichever is lower. So if a security are held as a stock in trade, then the valuation would be cost or NRV, whichever is lower. Here the NRV, students, so the first of all the cost will include what? Students, always be careful. ICDS 2, I should take you first to the ICDS 2. In this case, ICDS 2. Just, students, over here, valuations for the stock in trade. Students, this is important. For the stock in trade and the valuation for the assets. Okay, now as far as stock in trade is concerned, there is 2 ICDS. Which are those two ICDs? ICDs number 2 and ICDs number 8. ICDs number 8 is for securities, and ICDs number 2 is other than securities. Fine. How the valuation is to be done? Valuation is to be done on the basis of lower of what, students? Lower of cost or NRV. Lower of the cost or NRV. Okay. Whereas when it comes to the asset valuation, students, over here in this case, so asset valuation, students, you should always have this particular part. Asset valuation, students, there is ICDs number 9, borrowing cost, ICDs number 5, fixed asset, and the last one, students, is 43A, foreign exchange gain or loss, capitalization on the foreign asset. Foreign exchange gain or loss capitalization on the foreign asset. Okay. Now always keep in mind this, that so far as the assets are concerned, these assets are only dealing with the cost. What will be the cost? Okay, these assets are only to be considered for the cost, whereas the stock in trade in the form of the securities or in the form of this one, herein cost or NRV, whichever is lower. Now please understand here the difference between the two would be very important over here. In this particular case, when we talk about the security, the stock in trade cost, it will include what? It will include the taxes irrespective of what, friends? Irrespective of, in this case, the SENMAT credit that may have been taken. So if the SENMAT credit has been taken, even that will be a part of your cost. Students. Is that point clear to all of you? Whereas if it is only the asset, that for which you are taking the valuation, and if the SENMAT credit, students, if the SENMAT credit is taken on the tax like GST or customs duty, SENMAT credit has been taken, then it will not be a part of the cost. It is not a part of the cost. This is the fundamental difference between the cost in stock and trade, which will always include tax, duty and cess, irrespective of whether the credit has been taken or not. And in the case of fixed asset, the cost will exclude the tax, duty and cess if on that the SENMAT credit has not been taken. If on that the SENMAT credit has been taken. I hope that all of you have captured this particular proposition now, every one of you. So this is the point. So students, this is how the things has to be looked upon in this case. I hope that all of you are clear with this one. Apart from that, students, in this particular context, the cost here in this case will also exclude the subsidy on depreciable asset. Exclude subsidy on what? Depreciable asset. As per ICDS number, depreciable asset, students, that is important. Exclude subsidy on depreciable asset as per ICDS number 6. So therefore, in this particular case, the subsidy on the depreciable asset also would be reduced from the cost of the asset. Which asset? Not land, but the depreciable asset. Only on depreciable asset, the subsidy will be reduced from the actual cost. Whereas if it is on land, then that subsidy will be considered as an income. It will not be reduced from the cost, it will be considered as an income. I hope that all of you are clear with this one. So this is the entire aspect of this one. Now students, coming back on the security part, here the security valuation, when you have to do category wise valuation. Now what do you mean by category? Category means aggregate of the cost of that category, compare that with aggregate of NRV in that category. Aggregate of cost in that category will be compared with the aggregate of NRV in that category. Which are those categories, students? So category is, first category is shares. Shares will include both equity and preference. So take equity and preference, all the cost of all the shares and all the NRV as on 31st of March of all the shares. And then aggregate of the cost and aggregate of the NRV of the shares will be compared. Lower of the two is the amount. Same is for the debt security, debentures and all. Deposits, for that aggregate of the cost, aggregate of the NRV of the debt, lower of the two is that one. Convertible securities like bond, convertible bonds, convertible debentures will be considered a separate category, and of that category aggregate of the cost and aggregate of the NRV, compare and take the lower of the same. I hope that all of you are clear with this one. Now only one thing, students, you should just be very careful. Lower of, for the stock in trade, students, for the stock in trade we always say lower of cost or NRV. For stock in trade we say lower of the cost or NRV. There is only one exception to this principle, where for a stock in trade we only take NRV. We don't take cost or NRV, whichever is lower. For stock in trade we are only taking NRV. There is only one case, and that case is in the case of partnership firm. In the case of partnership firm, whether it is a change in the constitution or whether there is a dissolution of the firm, in both the cases it is only the NRV which has to be taken. It is only the NRV, students, which has to be taken. That is only in the case of a partnership firm. Therefore, in the case of partnership firm, whether it is a change in constitution or whether it is a dissolution, we will not take cost or NRV which is lower. We will always take only the NRV in this case. With that, students, we are done with this particular part, and now coming on this particular part, government grants also, I have done with it. Only part which is there for the government grant, students, ICDS number 7, sorry, government grant, students, subsidies. Subsidies, students, I have written ICDS 6. Please make that ICDS 7 if you have written, then make this as ICDS 7. ICDS 6 is for foreign exchange. So, students, in this case of ICDS 6, you should always keep in mind one point only. And what is that, students? This point. And what is that, students? That when you do the recognition of the subsidy, so the recognition of the subsidy will be done when there is a reasonable assurance. There is reasonable assurance on what? That the person to whom the subsidies are given will comply with the condition for the grant of the subsidy. The person to whom the subsidy is given will comply with the condition of the subsidy. And what is the second criteria, students? There is a reasonable assurance that the grant shall be received. There is a reasonable assurance on what? That the grant shall be received. So there is a reasonable assurance that the person shall comply with the condition and that the grant shall be received. So if there is a reasonable assurance for both, it is then that previous year in which the subsidies will be recognized. Okay, but supposingly, students, you have been given the subsidy in the very first year, and the condition may take, for fulfillment of the condition, it will be taking another 3 or 4 years. But the subsidy or the grant has been given to you in the very first year itself. So in that case, what they say, if you already have received the subsidy, then the recognition cannot be postponed beyond the year of its receipt. The recognition, students, shall not be postponed beyond the year of its receipt. That is what the recognition principle is all about. Now, subsidy will mean even the cash incentive. Cash incentive, subsidy, government grant. So, all this are example of duty drawback. They are all the example of subsidies. Okay. So, that is what it is in this case. However, it will not include what, students? The government assistance, like the government is giving technical support. Then that is not a subsidy. Okay, so that is not a subsidy. That is the point that you should always consider in mind. So again, repeat with me. Subsidies, which will be the previous year in which you will do the recognition. The previous year in which you will do the recognition will be the year in which there is a reasonable assurance that the assessee will comply with the conditions. Assessee will comply with the condition, and that there is a reasonable assurance for the grant will be received. The grant, students, will be received. With that point, students, we are done with this now. Foreign exchange contract, students, I already did with this. Just keep in mind only one thing, students, for foreign exchange contract. ICDS number 6. Only one point you should remember it. And what is that point? This is the point that you should remember it. As far as this foreign exchange is concerned, students, the only point that you should remember is whether 43A is applicable or not. What is 43A? I just now discussed with you for 43A. 43A require two conditions. Which are those two conditions? The associate has taken a foreign currency loan. What associate has taken? Associate has taken a foreign currency loan, and that loan has been taken in respect of a foreign asset. That loan has been taken for a foreign asset. So if the associate has taken a foreign currency loan and that loan has been taken for a foreign asset, then exchange rate fluctuation will be treated as per section 43A. Exchange rate treatment will then be as per exchange rate fluctuation on such foreign currency loan will be treated as per the provision of section 43A. And what is the provision of 43A says? It says that the previous year in which you will recognize the treatment of exchange rate fluctuation will be, which is the previous year? The year in which the loan has been repaid, either in part or in full, doesn't matter. So the previous year in which the loan has been repaid, it is only that year that the foreign exchange fluctuation recognition will be considered, only in that year when the loan has been repaid. And what is the second point, students? The second point is the treatment. What is the treatment? The treatment is the foreign exchange fluctuation in that year of payment will be capitalized to the actual cost, will be capitalized. So it means that it will not be a part of your P&L, it will be capitalized. So you just consider 43A, students, because other than 43A, for any other cases of foreign exchange fluctuation, ICDS 6 says it will be recognized as income or loss, as the case may be, income or expenses, as the case may be. So other than 43A, all the remaining cases will be treated as income or loss, as the case may be. That is the treatment of foreign exchange fluctuation. So if I tell you, students, that I have taken a foreign currency loan and that foreign currency loan has been taken to purchase an asset from India, then in that situation, if it is purchase, if the loan has been taken to purchase the asset from India, then whether 43A is applicable? No. If 43A is not applicable, then whatever is the exchange rate fluctuation gain or loss, that will be recognized. When it will be recognized? It will be recognized on the basis of MTM. It will be recognized on the basis of MTM. M2M means mark to market. And how it will be recognized? Other than 43A, how it will be recognized? It will be recognized as profit or loss, as the case may be. So this is what other than 43A. See the contrast. In 43A, the when is not MTM. MTM means 31st March every year. So when is not MTM in 43A? When is the year in which the payment is done? And how? In 43A is what? Capitalization. Whereas here, how is P&L? That is a difference between the 43A exchange rate fluctuation versus the any other foreign exchange rate fluctuation, gain or loss. I hope that all of you are clear with this one. With that, now students, the last ICDS which I am doing it with you is ICDS number 5, which is on tangible fixed asset. Now, as you all know, students, tangible fixed asset in this particular context, so this is about the valuation to determine the cost. I already told you that how the cost of the fixed asset has to be determined. That is what this ICDS 5 is all about. Now students, there are three things which is there. This is 1, this is 2, and the third one, students, is about the repairs. This is 3. So you need to only revise the 3 points. First one, ICDS 5 deals with standby equipment and the servicing equipment. Please read the adjustment very carefully. If in the adjustment they tell you that standby equipment has been purchased, then or servicing equipment has been purchased, then what you are going to do? Simply capitalize in the actual cost. If in the question they say machinery spares, students, please be careful. They are using the word machinery spares. If they use the word machinery spare, students, then you will say ICDS 5 capitalized. But if they use the word spare parts, students, please see the difference. If they use the word spare parts, then students, you will say deduction. Check the wording in the question. If they are using the word machinery spares, you will capitalize it. If they are using the word spare parts, you will claim a deduction. I hope that all of you are clear with this one. Now, in this context, point number 2, for the fixed asset, how the cost has to be determined. So they have given you some of the items. What should be the treatment of these items? So they say that the actual cost of that particular fixed asset shall include what? Import duties and taxes. But I told you already that if you have taken the SENMAT credit, that is, if the duties and taxes are refundable or recoverable or SENMATable, then it will not be a part of your actual cost. Directly attributable expenses on making the asset ready for its intended use. Yesterday one question came in alternate tax regime 115 BAB, wherein salary paid to the technician for installation of the plant and machinery. Salary paid to the technician for the installation of plant and machinery. So that is what? Directly attributable expenditure for making the asset ready for the intended use. So therefore what we have done? Capitalize. Expense on startup and the commissioning of the project. Expenses on the test run. Be careful now here. Test run expenses, students, will be capitalized. Test run expenditure will be capitalized. And if any output is generated in the test run, and the output is sold, then the sale proceed from such output, will be reduced from the cost. Okay, so therefore one thing which you should be careful about is the output of the test run. If it is sold, then the sale proceed will be reduced from the cost. Now, one point of ICDS 9 I forgot, borrowing cost. One very important point, students, of ICDS 9 on borrowing cost. I have taken the loan. The loan was taken for the purpose of purchase of plant or construction of the plant. However, presently that loan is idle. The loan which I have received is kept idle. So what I do? Temporarily, I am investing that loan amount in some short-term securities. Temporarily, I am investing that loan amount in some short-term security. Which loan amount? The idle fund. This is an idle fund presently, because I am not using presently this loan amount. So what is the treatment of the interest income on this short-term securities that I have earned from the investment? What is the treatment of the interest income from the short-term securities? So the treatment is, it will be charged under the head IFOS. It will be charged under the head IFOS and it will not be reduced from the cost. Be careful on that particular point. Okay, this is, I'm talking about loan has been taken, presently idle, so temporarily invested, and from that investment interest income generated, IFOS, and not to be reduced from the cost. But test run expenditure, that test run expenditure, capitalize. Output of the test run, if sold, then the sale proceed will be reduced from the actual cost. So that is what this point number 2 is all about. Now the last one, students, is improvement and repair. So students, if supposingly they give you in the question replacement of what? Replacement of the building, of what? Of the roof, building roof. Replacement of the building roof, students, then what you will do? Capitalized. Why? Because it is increasing the future benefit. By replacing what? The roof, it is increasing the future benefit. So if they give you like this, or they use the word that this repair expenditure is increasing the future benefit from the existing asset. If the word that they are using is future benefit increment, then that repair has to be capitalized. Or replacement of a roof, that repair also has to be capitalized. But if it is a normal repair and maintenance, if they use the term normal repair and maintenance, then what you're going to do? Allowed as deduction. So when in the case of repair, two type you are going to capitalize. What are those? One, if they tell you replacement of the ceiling, building roof, that point of time, capitalize. What is the second point? Second point is repair expenditure which will increase the future benefit. At that point of time also it will be capitalized. I hope that all of you are clear with this one, and that exactly is the point. Now students, the ICDS number 4 which has been there in this context, the ICDS number 4 students which has been there is on the revenue recognition. And on the revenue recognition students, as you all are aware, on the revenue recognition students, as you all are aware, for ICDS number 4, for the goods and services, students, for the goods and for the services, please tell me, for the goods and services, so far as the services are concerned, now be careful. If the period for which these services has to be provided, if that period is for less than 90 days, the period for services is less than 90 days, if the batch is say for less than 90 days, then the completion method can be considered. Completion method, that is when the services would be completed, the revenue would be recognized. But if the period is more than 90 days, or if the question is silent in the examination, then for the services, the percentage of completion method only has to be adopted. For the services, the percentage of completion method only has to be adopted. And as far as the percentage of completion method is concerned, students, you all know at a stage when the services are over, that stage, the percentage of completion method has to be adopted. Now students, please understand the percentage of completion method is also adopted for ICDS 3, which is the construction contract. Construction contract. In construction contract, students, herein, in this case, what happens is that, just a second students, one particular point. So in this particular case, students, in the case of construction service, ICDS 3, in the case of construction service, students, what happens, students, over here? Now, in this case, please be very careful. If your ICDS 3, couple of points, students, which has been there. First of all, the scope, couple of points, students, which is very important for ICDS 3. I'm taking across the important particular areas. In the case of the scope, students, be careful. It is the scope of ICDS 3 will be for not only for the construction contract, but it will also include contract for rendering the services which are directly related to the construction of the asset. So examples are architect service. So for them also ICDS 3 is what has to be applied. So that is point number 1. Second important point, students, is that you have to check what is the stage of the completion of the construction of your project. What is the stage of the completion of the construction of a project? Now, if it is up to 25%, now be careful. ICDS 3 is for recognition of both the cost as well as for revenue. For recognition of both the cost as well as for revenue, that ICDS 3 is what has to be considered. Now, when I talk about the cost in this particular case, or when I talk about the revenue, just check out what is the stage of completion on 31st of March. If it is up to 25% only is the stage of completion, then in that particular case, students, the revenue can be recognized to the extent of the cost. So if it is up to 25% of the completion, then whatever is the revenue, that can be recognized to the extent of the cost, meaning thereby you don't take 25% of the estimated revenue. What you do, simply whatever is your cost incurred till that 25%, that will be the same revenue for the construction contract. That is what it is. And if it is beyond 25%, directly I'll take you to one example. If it is beyond 25%, students, then one example, students, quickly I'll make you refer to this one. This is what it is, students. Let's have a look. If it is beyond 25%, in this case, let's take it is, students, so that is optional. By the way, students, that is optional, which I told you. that up to 25% the revenue can be recognized up to the extent of cost. That is optional to the SSC. If the SSC wants to offer it as per POCM, no hard and fast rule, he can go ahead with that, but that is only an optional which has been given to him. Now if it is 23% completion, and assuming that the SSC is not following that position, what is the position? Revenue to the extent of the cost. So if he is not following that position, if the estimated revenue is 5 lakhs, then in this case the total revenue that will be recognized for that year. So estimated revenue means of the entire contract, of the entire project. What is the entire project? What is the revenue? Is say 5 lakhs. So, and by the end of this year one, you have completed 23%. So how much is the revenue to be recognized? 1,15,000. Say at the end of second year, 74% is completed. And how much is the cost? How much is the revenue? 5,50,000. You'll say, sir, how come revenue has increased? Obviously, estimation can change na, year by year. So now my estimation is 5,50,000, which I will earn. So in that particular case, how much is the total revenue to be recognized? 4,07,000 rupees. Now, out of 4,07,000 rupees, which is 74%, 23% of 1,15,000 already have recognized earlier. 23%, which was 1,15,000, I have already recognized. So therefore, the balance recognition in this year would be how much? 2,92,000. And the last one, students, is third year it is 100%. So of 5,50,000. So there is no increase or decrease of the estimated revenue. So therefore now it is total revenue to be recognized will be 5,50,000 fully. Okay, but up of 5,50,000 up to 4,07,000 I have already recognized. Up to 4,07,000 I have already recognized. So the balance recognition which I have to do in year number 3 is only 1,43,000. Same is also for the cost. So whatever is the cost for year 1, year 2, year 3, based on the percentage of completion, you are going to recognize it. And second year, you will reduce whatever recognition you have done for year number 1. In third year, you will take the percentage and apply on the estimated cost, and whatever is the amount, on that amount please reduce whatever recognition that you have done up till now, and the balance is what is the recognition. This is what it is. ICDS is over. So with that, students, now your ICDS is over. Now very quickly, students, surrogate taxes. I will do one question with all of you. Only one question, students, I am doing with you on surrogate taxes, just to complete that particular area of surrogate taxes. One question only I am dealing with it now on surrogate taxes, students, on this particular part. Students, so this is this question of Mr. Rajesh. No. Of Mr. Rajesh, students, there is one more question. Students, over here, as far as Mr. Rajesh is concerned, yeah, just have a look. Mr. Rajesh is a unit holder, resident unit holder of PQR Limited and Shipra Limited. Okay, so he is a unit holder of both PQR and Shipra. PQR is AIF. So PQR is AIF and Shipra is REIT, Business Trust. Now this business trust holds 100% in GPL Limited, an Indian company. Mr. Rajesh holds 10% of unit in both Shipra as well as PQR. Okay. Now if you remember, students, so far as the AIF is concerned, you may be recalling this particular factor. What is that, students? So far as the AIF is concerned, there is a pass-through, partial pass-through, students, which is there as far as the AIF is concerned. And what is it, partial pass-through, students? Please recall. So far as the partial pass-through is concerned, the PGBP income of the AIF is taxable in the hands of the AIF. All the remaining income is passed through, taxable in the hands of whom? In the hands of the unit holder. Only the PGBP income is taxable in the hands of the AIF. All the remaining income is taxable in the hands of whom? In the hands of the unit holders. What about the securitization trust, students? So far as the securitization trust is concerned, if you know that, students, in securitization trust, entire income of the securitization trust is accessible in the hands of the unit holder. As far as securitization trust is concerned, entire income of securitization trust is taxable in the hands of whom? In the hands of the unit holders. Isn't it? And that exactly is the point. So that is how the things has to be looked upon. What about the REIT? So far as the REIT is concerned, students, REIT is receiving rent. First of all, from the SPV it is receiving interest. From the SPV it is receiving dividend. From the special purpose vehicle it is receiving interest. From the special purpose vehicle it is receiving dividend. That interest income and that dividend income is not accessible in the hands of REIT. It is exempt in the hands of REIT, and it is accessible in the hands of whom? In the hands of the unit holder. Okay. Now unit holder can also claim exemption on the dividend income which was received by the REIT from the SPV if the SPV is not opting for 115BAA. If the SPV is not opting for 115BAA, then the dividend that the unit holder has received through the REIT, that dividend income would also be eligible for exemption. Means no tax at all on the dividend income. Interest income, definitely it will be taxable in the hands of whom? In the hands of the unit holder. Interest income from whom it is received? It is paid by SPV to the business trust, and later on the business trust has passed on to the unit holder. So that interest income will be taxable in the hands of whom? In the hands of the unit holders. Apart from the SPV, the REIT or business trust is also receiving some direct income. Now what is that direct income? Direct income can be rent from the property which has been leased out or let out by the REIT. Now that rental income which has been received by the REIT, that again is not accessible in the hands of the REIT, but it is accessible in the hands of the unit holder. Now question to all of you therefore is that rental income will be assessed under which head? In the hands of the unit holder, the rental income will be assessed in which head? It will be assessed in the same head the way it would have been assessed in the hands of the REIT. So the way it will be assessed in the hands of the REIT, same will be the head in which the assessment will be made in the hands of the unit holder. So in the hands of the unit holder, this rental income received from the REIT will be accessible under the head PGBP. Will be accessible under which head? Under the head PGBP. Is that part clear to all of you? Profit and gains from business and profession. Okay. Now you'll say, sir, what is the use of the head-wise classification? It is important because set-off of losses are important. Na? Set-off of loss, if it is in that head, so you should be very careful. The classification in the correct head is important. So just keep that in mind, that the way it would have been assessed in the hands of the REIT, same would be the assessment in the hands of whom? In the hands of the unit holders. But apart from rental income, if there is any other direct income, then that direct income will be taxable in the hands of whom? In the hands of the REIT itself. Now what are the example of other direct income other than rental income? The examples are, for example, I'm just giving it to you, long-term capital gains of 112A. Then that long-term capital gains of 112A will be taxed at the rate of 10% after reducing that 1 lakh. Or long-term capital gains of 112, that will be taxed at the rate of 20%. Or short-term capital gains of 111A, that will be taxed at the rate of 15%. Or other than this, any other income any other income, students, then that will be taxed at MMR. And what is the MMR? In this case, MMR, as you know, 30 plus 37% plus 4%, which I think is 42 point something. So that is the any other income will be taxed in the hands of the REIT at this particular rate. Okay, that is how it will be considered. So this is how the things are there for the REIT. So this is how the assessment of REIT income will take place. What I told you about, students, the AIF I told you PGBP income is assessable in the hands of the AIF. All the other income is accessible in the hands of whom? In the hands of the unit holder. What if the other than PGBP, if there is a loss, like for example, there is a long-term capital loss. If there is a long-term capital loss, then students, in that case, this long-term capital loss or long-term capital loss, will that also be allowed to be passed through? Whether this long-term capital loss, will that be allowed to be passed through? To that the answer is yes, provided what? The unit holder is holding for more than 12 months. So that period should be more than 12 months. Only then, if the unit holder, those unit holder who are holding the unit for more than 12 months, only for them the pass-through of that loss is available. If there are few unit holder whose period of holding in that AIF is not for more than 12 months, in that particular case, that much portion of the loss, in my example of long-term capital loss, that much portion of the loss will get lapsed. That much portion of the loss, students, will get lapsed. Is that point clear to all of you, students? And that exactly is the point. So with this, students, now on this backdrop, now this last point, students, is also very important. GPL Limited. Now let's see what are the income, students. Shipra is the REIT, and this is AIF. So dividend income received from GPL. So this dividend pass through in the hands of unit holder. Income from GPL, in this case, which income? Interest income, students. This is interest income. Interest income 3 crores. Again, there will be a pass through. Short-term capital gains on sale of development properties. Sale of development property. Now that would be MMR. Not 111A. 111A is for securities. Business income. Now this business income, students, if you can see in this case, business income 35 lakhs. AIF. This particular part, long-term capital loss, students, long-term capital loss, unit holder, pass through. Interest income, unit holder. Now let's see the last paragraph. GPL Limited does not exercise the option of 115BAA, and if it does not exercise the option of 115AA, then this dividend, if this does not exercise the option of 115BAA, then this dividend income of 2 crores will be eligible for exemption. Shipra Limited and PQR Limited distribute 90% of its income to the unit holder during the year. This is important, no, students? This part is very important. Now, students, if you see over here in this particular context, students, be careful on this part. AIF and securitization trust on one hand and REIT on another hand. In respect of REIT, how much is distributed is what has to be considered. So they have said that 90% has been distributed. So only that will be considered. But for AIF and securitization trust, irrespective of the percentage of distribution, the entire amount has to be considered. Irrespective of the percentage of distribution, the entire income has to be considered. Is that point clear to all of you, students? Entire income has to be considered. So even though 90% is distributed, I will take 100%. For whom? For AIF and securitization trust. So let's have a look, students. Now dividend income is exempt. So I have to compute for Rajesh. Rajesh holding, how much is the Rajesh holding? 10%. So 10% of the above income, I will consider it. But this dividend income is exempt in the hands of Rajesh because of this SPV criteria. Interest income is 3 crores. Of that 3 crore, students, how much is distributed? REIT is there. So how much is distributed is 90%. So therefore it is 2.7 crore. How much is Rajesh holding? Is only 10%. So therefore it is 27 lakhs. Now short-term capital gains, this will be in the hands of the Rajesh or it will be in the hands of the REIT. REIT at MMR. So at MMR, which is 42.744%, that is the amount that will be taxable in this case. Business income of, now this is the, students, this is the SPV, this is AIF. Now business income, is it taxable in the hands of Rajesh or it is taxable in the hands of AIF? It is taxable in the hands of AIF. So as far as Rajesh is concerned, it will be exempt. As far as the Rajesh is concerned, it will be exempt. And the second one, students, long-term capital loss of PQR Limited. If you can see that, long-term capital loss of PQR Limited, students. Now in that situation of 10% of 27 lakhs in this case. Now, is he holding for more than 12 months? Is that information given to you in this case? In this situation? Yeah, since 2020. He is holding since 2020. So because he is holding since 2020, more than 12 months, and because it is more than 12 months, so of 27 lakhs of LTCL, Rajesh holding is 10%. So it will be 2,70,000. But 2,70,000 I cannot write over here for Rajesh. Why? Because this is LTCL, and LTCL can only be set off against LTCG. So therefore I will not write it over here. What I will write, because there is no LTCG, I will carry forward. And last is the interest income in this case. Now see, how much is this? Interest income is 52 lakhs. How much is distributed? 90%. But will I take 90% or entire 100%? I will take entire 100%. And if I have to take entire 100%, students, 52 lakhs only have to consider it. And how much is Rajesh holding in this case? 10%. So 5.2 lakhs. 5.2 lakhs, and this is how it will get you the total income. Okay. Now only one thing, students, you have to do in this surrogate taxes, and that is, students, is the case of, in the case of the buyback tax. Only the buyback tax, students, you will just ensure to run through it. In the buyback tax, students, as you all know, what happens in this case? As you all are aware, students, 23.296, that is 20% plus 12% plus 4%. That has to be applied on the income which has been distributed by the company to the shareholder. The income which has been distributed by the company to the shareholder, on that income, the percentage of buyback tax which the company has to pay is 23.296%. Now, by the way, students, by when they need to pay? What is the due date, students? 14 days from the date of the payment. So by when the company has to pay? 14 days, students, from the date of payment of consideration of such buyback. Yesterday, AIF also we did exit tax. Exit tax you have to pay within 14 days from the specified date. Specified date is the date of merger, conversion, or dissolution, as the case may be. Here the company will have to pay the buyback tax within 14 days from the date of payment, and if there is any default in that case, then the interest at 1% on the delay in the payment, which will be beginning from the date following the date on which the tax was payable and ending the date on which the tax is actually paid. So when it is payable, within that 14 days. So after the expiry of 14 days, the interest will kick in. So the interest calculation for the buyback tax delay and the exit tax delay is the same. So that is what it is, students, in this context. So I hope that all of you are clear with this one. This covers up your, students, securitization trust. Now with that, students, I will quickly now revise with you. I don't have the PDF, but I'm just going to speak about the PGBP part. Those who have done with the other portion of PGBP, they can quit, or else probably we can just continue in this case. So students, other than this sectorial particular provision of PGBP, if I have to tell you about it, one is on the banking company side, students. One is the banking company side. In the banking company side, students, for the sectorial provision, you always consider this thing, that the provision for bad and doubtful debts generally is not allowed as deduction, but for the banking company it will be allowed as deduction. Only exception is the banking company. Now be careful, students. Banking company is one category. Foreign banks, in this case, foreign banks and public financial institution and the NBFC are other category. NBFC, they are other category. Now this banking company, students, if I have to tell you in this particular context, you will have the bank, normal bank, scheduled bank, cooperative bank, which are being there. Okay, so that is what it will be considered over here. Now they are getting a deduction. So here of the adjusted total income, students, they get deduction of their adjusted total income. Now what is this adjusted total income? Simply put, students, it is GTI before 3617. It is GTI before 3617A. Of that adjusted total income, how much is the percentage? 8.5%. And whereas for all these, it is 5%. All these, it is 5%. Apart from that, students, there are additional provision also which is allowed. What is the additional provision, students? In this case, 10% of the rural advances that has been paid. So that is a top up which they will get it. So please understand, the banks are getting the deduction on the basis of the provision for bad and doubtful debts. That is what this section 3617 is all about. So in that case, students, what you have to do in the question is that any provision which the company would have made as per the books, because the company may be following the RBI prudential norms. So any provision that they are making it as per the books, those provision needs to be added back. Those provision, students, needs to be added back. Which are the provision? Like they will give you provision as per the RBI prudential norms in respect of standard asset, substandard asset, NPAs, all those things please add back, because as per the books we don't consider the provision, we consider the provision only as per section 3617A. So as per section 3617A, I will consider the provision of 8.5% and additional provision, but this additional provision of 10% is not on what? It is not on the GTI before 3617A. It is on what, students? It is on the rural advances average, which they will give you in the question. So this is a provision that will be allowed. Now, whether the actual bad debts, will that be allowed as deduction? Answer is no. So if bad debts has been debited in the P&L account, you will add it back. Why you will add it back? Because you are getting the deduction of the provision. So if the deduction is on the basis of the provision, obviously you cannot get a deduction on the basis of the actual bad debts. But only in one case, the actual bad debts will be allowed as deduction. And that particular one case is when the actual bad debts exceed what? Exceed the total provision made so far. And that total provision would mean the current year provision plus the last year provision, earlier year provisions. So if the actual bad debts exceed the total provision made so far, then only to the extent of the excess of the provision, that the deduction of what? Deduction of the bad debts will be allowed. Otherwise, no. Apart from that, friends, there is one more special provision for the banking company, which is the provision of section 43D. The interest on NPA category of loan, NPA loans. This NPA loans are also known as sticky loans. Sticky loans. This NPAs are also known as sticky loans. This interest income will be recognized only in the previous year in which the interest is actually received. Only in the previous year in which the interest is actually received, or credited in the books of accounts, whichever is earlier. Or credited in the books of accounts, whichever is earlier. So if the interest on the NPA, if the bank has neither received it nor it has credited in the books of accounts, then that interest cannot be considered as the income. For whom? For the banks. And the last one, students, what the banks do? They are holding the investment. Students, the banks are holding what? Holding the investment for what, students? The purpose is, in this case, they are holding the investment, in this case, for trading purpose. If they are holding the investment for trading purpose, then those investments are considered as stock in trade. And if they are considered as a stock in trade, then the valuation would be as per the cost or NRV, whichever is lower. That is how the valuation has to be done as far as that investment is concerned. So this is so far as 43D is concerned, students. And now my students, my point is that I think that much is sufficient. All of you now will be revising quickly 3580 in this particular context, and thereafter 3618. Quickly 33AB, students, you will have to go through it once, because even if we discuss it out, and the presumptive income, students, these section, students, I will request to all of you to go through it once. 3580, 3618, 33AB and presumptive income, as what we have done in the class. Please refer on that particular basis, and that should be all. Is that point clear to all of you, friends? Just immediately refer it, because even if we discuss it, you will have to end up referring it. So there is no point in further wasting the time on this one. So now, students, what I will do is that I will give you a 30 minutes video. Maybe at night I'll record it and I'll keep it with all of you. This will be for the theory on the NR. The theory on the NR. In this case, I'll try wrap up in 30 minutes, and that if you want to see in the morning, because only you can retain that much in the morning. You just, whatever you see, only that is what you're going to push it on the examination. Is that one clear to all of you, students? So this is the last video, students, which I'm going to put it across. I understand that there was an indirect transfer video, students, which has been there, but if you can just refer that Barbara INC question, and I think that should solve the entire this thing. So I think that now I think the time is a premium for all of you also. So in this situation, updated return, I think Aishwarya, you can just read it across it. Maybe will not be this thing would be required at my side. Updated return, students, just see what is the additional amount of tax and updated return, students. Just very quickly, I'll give you a checklist, students, for the updated return. All of you on the updated return side, students. So updated return, students, which you all are aware. So first point, students, as you know, within 24 months from the end of the relevant AY, you can file the updated return. Now there is a payment of additional tax. Payment of additional tax, you will have to do it. Additional tax has to be done. Now this payment depends upon the period within updated return file. Now that depends on when updated return filed within 12 months, or it is after 12 months, but before 24 months, because 24 months is the maximum time, na? So in that particular case, students, what will be the amount? Here it is, the additional tax would be 25%, and here it would be 50%. That is the additional tax that you have to pay. That is the second particular point that you have to consider in the checklist part. Now in this case, updated return, students, can an updated return, it cannot be a loss return, which we all know. It cannot decrease tax liability. And the last one, students, is that it cannot result into refund. That is also the point which has been there. Now, who cannot file the updated return? Just like DRP, Dispute Resolution Panel. Who cannot file? Cannot file updated return? Who cannot file updated return? So the situation, as you all are aware, students, is the situation in which all you are aware of it, which is that case of 132, 132A, 133A. Those are the cases. If the assessment is pending, prosecution has been initiated, and thereafter the information from that 1990A, it is just like your DRP part, students. And then that particular case of money laundering, black money, smuggling and all. So that is the case of this particular part. From this tax that you are talking about, this additional tax plus interest, this additional tax has to be along with interest. That point number 2, that additional tax that we are talking about, it has to be along with interest, students. Okay, so along with interest, so that's exactly what it is. So this is what your updated return, students, is all about. So I've given you the checklist for the same, and on that basis, students, you are supposed to now deal with this particular part. So I hope that all of you are now clear with this particular part. Fine, students. So now all of you quickly, students, if you are supposed to do this buyback tax, immediately you do the buyback tax, that how to compute the income, which you have also discussed it earlier on the buyback tax. That is point number 1. And second one is the other section which I've earmarked for all of you for PGVP. That is what it is. So now 30 minutes video, students. I'll just share with you on indirect transfer, students. Indirect transfer, directly refer that question on Barbara INC. directly refer that question, students, on Barbara NC. That should be sufficient enough to wrap it up, students. Okay, so therefore now 30 minutes video at night, I'll just record it quickly and just put it across for the theory of the international taxation. In the morning, half an hour, read it, wrap it up, move on. Fine. Quickly, students, now wrap it up. If there is any other topic which you see that, sir, how to tackle that, I can easily, for the last like 2 or 3 minutes, I can just let you know how you will deal with it in terms of any particular topics of your concern right now which is still left. So you can just let me know. I can just let you, guide you how to really go about it quickly, students, in the next 2-3 minutes. So that is what, students, just keep this mind. Again, the paper presentation, students, 15 minutes, you will select those 2 questions. Thereafter, students, you look upon to question number 1. It's compulsory, so you cannot avoid it. Read the first paragraph, last paragraph of the question number 1, then start doing with the adjustment, some adjustment. Even if you don't know, don't worry, whatever the best that you can do it, do that. Get into the total income in this particular case. Okay, that is what I'll suggest to all of you. Then you can go for the MCQ, but the big integrated MCQs and the case studies, please leave it. Don't do it initially, because first your option should be, you should try to then search those descriptive questions which you have done something about it, which you have done something about, you know about those sections. So please write it properly, and then go to that go to that in big question of integrated small MCQs and all, if are there, or those which are known, which you already know that, sir, this we have read it and that has came. Please do that. Don't deal with it. Okay, Ram, Aishwarya, and all of you, students, all the best to all of you. Do well, you'll see it through, don't worry. And remember one thing, if it is difficult for you, it is difficult for all of them across India. Okay, immediately after the paper is over, students, do share that question paper with me. I'll be eagerly waiting for that question paper. Okay, see you then tomorrow. Take care. Please just keep that in mind. Now, if it is tough, it is tough for everyone. If it is lengthy, then it is lengthy for everyone. Just pray to the God, take deep breath, and then sit for the paper. Keep your mind cool. Have your strategy clear as to last half an hour. Paper lengthy, your selection of the question, try to complete it. Just maintain your composure. Your best has to come out. Your best character has to come out now in your examination. All the best. Take care.